Hello, I'm Peter Walton from Zenith, and we're talking to you today about changes to your investment portfolio. So firstly, what are the current factors that we have in mind? There is inflation, which is linked to rising interest rates, which is also linked to the possibility or probability that we might have a recession. In terms of recession, it sounds like a scary word, but there are different types of recession. You can have a technical recession, which is 2 quarters of negative economic growth, or you can have what's a more full-blown recession, which can have much greater consequences. From our viewpoint, the word recession or the existence of a recession is not necessarily a catastrophe, but it is still relevant. Some of these factors can have good outcomes. For example, rising interest rates mean that term deposit rates are much better than what they were. Now 3.5% on a 12-month term deposit is quite common compared to perhaps 0.5% not that long ago. Other factors that are still relevant are the continuing tension that Australia and other countries have with China, which seems to be ongoing with no particular direction or change. And of course there are matters relating to Europe, being the war in Ukraine, the threat of gas supply disruptions in Europe, causing disruption to energy prices and economic growth prospects. Now, the resolution of some of these things is quite unknown, and things can certainly turn downwards very quickly. But at the moment, the share market does often take a different view of things. It's very forward-looking. And while inflation interest rates are going up and continuing to go up, the markets tend to think, well, that's now the new normal. Those factors have been in play for a few months now. So what is the future? And it does seem, as the reporting season unfolds, that good quality companies still find a way to report satisfactorily, and the market therefore moves on and looks more to the future rather than what's currently still happening. From our perspective, we want to be as best placed as possible to take advantage of a more favourable situation. So we've moved our portfolios to what we call more normal settings. So a conservative portfolio will still be conservative, but not as conservative as it has been in recent months. And similarly with portfolios that are classified as either balanced or growth, they still have a mix of growth and conservative or defensive assets, but in a more normal manner. If things change and situation deteriorates, we're able to make changes again very quickly, but we want to be in a position to take advantage of any change in momentum, which does seem to be the case over the last few weeks. And your portfolios have probably shown some increase in value in this short period, and we hope obviously for more positive news and positive outcomes. Please feel free to log on to your portfolio to check any changes. And if you have any questions at all, please feel free to contact us. We wish you all the best, and we will be in contact again soon. Thank you.